Hi, and welcome to 60-Second Money, Back to Basics. Today we're going to be looking at the payout ratio. When it comes to dividend stocks, one thing you should look at before you put money into that asset. So today we're going to look at what is a payout ratio, why it's important, and where to find it. Starting with the why and what. What is it? The dividend payout ratio is defined by Investopedia as the percentage of earnings paid to shareholders in dividends. Now, that's calculated by taking the dividends per share, the amount of money per share that company is putting out, and dividing that by the earnings per share of the company, or how much money that company earns. It can also be measured by taking those same dividend per share and dividing that by the cash flow. Certain companies will do that because things like depreciation and amortization can also influence those earnings. So you want to take a look at how much cash they're putting out versus how much cash they're pulling back. This is one thing you want to look at before you put money into a stock. Here's why. It's a great indicator of how safe that dividend payment is. In general, the lower the payout ratio, the better. So for example, if that payout ratio is more than 100%, that means they're paying out more in dividends than they are earning. Typically, that's not good. The other thing you want to look for is you want to look for a stable payout ratio over time. So this is important because you want to make sure that company has a safe and stable stream of income that you are purchasing. Commodity companies, for example, typically have much more variable payout ratios. Here's where you can find it. Number one, Google it. Google the stock you're looking at, Royal Bank of Canada, dividend payout ratio. Take a look at the investor relations site on that company's website, or just use Google Finance or Yahoo Finance, both of which usually have the payout ratios, and it's all free. So, to recap, the payout ratio is one measure of the safety of the cash flow of that asset. You calculate that by taking the dividends per share and dividing that by the earnings per share of the company, or perhaps the cash flow. The lower payout ratio, the better, and where you can find it, just Google it. Up next, we're going to take a look at how to add another 1% to your dividend income almost risk-free. This is 60 Second Money. Thanks for listening.